Now that we have a better understanding of the business, let's look at the company financials. For me to classify Capitec as a great business, it must meet the following criteria. It must have consistently increasing revenue, consistently increasing net income, net profit margin must remain above 25% consistently, return on equity must be above 12% minimum, but preferably 15% and consistently so. It must have conservative debt. It must have an economic moat, that competitive advantage that protects it from competition, and the business must be growing at a reasonable rate. Now let's go through each step. Number one, is revenue increasing consistently? Yes, revenue is increasing consistently over the last 5 years. Is net income increasing consistently? Yes, net income is increasing consistently over the last 5 years. Now, bear in mind, the revenue and net income does not have to go up every single year, as long as the overall trend is upward. But for your information, the dip you see in revenue and in net income in the 2021 financial year is due to the external impact of lockdown and July 2021 unrest. It had nothing to do with the performance of the business itself. Moving on to the third criteria, net profit margin. Is it above 25% consistently? As you can see, over the last 5 years, it's been above 25% consistently. And you can see that the average of the last 5 years is 35%, which is great and is higher than the industry average of 27%, which means that Capitec is an efficient profit-making machine. Looking at the fourth criteria, which is the return on equity, we can see that return on equity over the last 5 years is consistently above 15%. And the average is 25%, which is great. And we can see it is much higher than the industry average of 10%. What does this mean? It means that Capitec is very efficient in converting shareholder money into profits. And therefore, the shareholders get more back for their money. Moving on to the fifth criteria, which is the debt structure. Now, I like to invest in companies with very little or no debt compared to the amount of cash that they have on hand. I do not invest in companies that are drowning in debt, because those companies are usually high risk of bankruptcy, and they generally tend to give lower returns because the profits that they make, instead of going to shareholders, it goes into servicing that large debt that they have. So I stay away from those companies. For Capitec, you can see that they have plenty of cash, which is the lines in green, compared to the amount of debt that they have, which is the red lines. You can see the pattern. More cash than they have debt, which means that Capitec can easily pay off its debt and still have plenty of cash remaining on hand. And we can see this from their cash to debt ratio of 7, which is higher from the minimum required of 1 and the industry median of 1.33. Their capital adequacy ratio is at a healthy 36.3%, much greater than the minimum 8 recommended. This means that Capitec has ample capital to deal with unexpected losses and hence lower risk of insolvency. And we saw this from their resilience and their ability to recover from the impact of lockdowns and the unrest that we had in July of 2021, where a lot of their branches were burnt down to the ground. We saw how they were able to rebuild and come back online at a very fast pace, and that was due to the amount of cash that they have on hand versus the amount of debt that they have. They're able to bounce back very quickly, and that is why I believe that Capitec is a safe bet, and they're here to stay for the long haul. Having looked at the company financials, we can see that Capitec is a well-run business. But even if a business is well-run, if it does not have an economic moat, that competitive advantage, that edge that protects it from the competition, it will eventually be overrun by its competitors. I invest in companies that have a wide economic moat, companies that are a monopoly. But due to the nature of the banking industry, I classify Capitec as having a narrow moat, simply because of the nature of the banking industry, which is price competitive. They have a narrow moat because of the following reasons. Market leadership. They are leaders in the bank. They are one of the leaders in the banking industry. And that gives them that slight edge over their competition. They are the largest bank in South Africa by number of active clients, and they are the second largest by assets. They've been recently voted as the best digital bank in South Africa, having 10 million clients. You can see that it is definitely one of the banks that are at the forefront, and they're leading, and they're market leaders. Number two, they have economies of scale. The ever-increasing size of their active client base enables them to offer products and services at a lower cost than the competition. Lower banking fees attracts even more customers. So their reputation is a cheaper bank to bank with, gives them that edge, that competitive advantage that keeps them at the forefront of the industry. Lastly, looking at their growth, they have been growing at an excellent rate of 17%, and they are projected to continue to grow at 17% over the next 5 years. And one of the growth drivers that is expected to continue to fuel that growth is their disruptive innovation. Capitec has an aggressive drive to gain market share in the digital payment space. This payments market is estimated to be worth 1.3 trillion rands in 2021 and is projected to grow at a rate of 7% during the period of 2021 to 2035. So this payments market, along with other innovative drivers and initiatives, is expected to help Capitec maintain their excellent growth rate of 17%. So we have had a look and gone through all my criteria of a great business, and Capitec has passed each and every single step with flying colors. So I can safely say, according to my criteria, I classify Capitec as a great business to invest in, and that is why I am watching with eager anticipation for the share price to come down low enough for me to start buying shares.